consumer and producer price index. Now, 1 month does not make a year or a trend, but it's kind of interesting that if you note,
Yeah, you could show that.
the 10-year jumped from 0.53 to 0.71, okay? It's not a big deal one way or another, and it sort of ties back to the question of whoever sent me that email about looking around for a CD or something like that. Unless you have a lot of time to waste, I wouldn't even waste my time looking around for CDs. I mean, basically, you're talking about nothing, you know? You're talking about getting anywhere from 0.1% to 0.5%. And I would just say to that question that you threw out, don't go too long on maturity, okay? You may see by the first quarter of 21, you may see a real uptick in yield, okay? Even with the Fed staying close to zero. The market will take care of that. You don't need the Fed to move one way or another. So I think, you know, from that point of view, I don't know, Len, you start off. You can ask about Election Day or anything else that you think is pertinent.
Yeah, I mean, the only, I did see that there was a bank that was issuing something like 1.16% on a checking account or a money market account.
Right.
That was the best I could see, and they wanted a $500 deposit to open the account, and they were based out down in West Virginia someplace. I'm looking for what the bank was. It was an article I think I saw in Kiplinger's, and that's the only. I didn't see anything that looked appealing other than that.
Yeah, but why would you even be doing that?
I agree.
Taking your eye off the ball, okay?
Verizon gives you over 4%, you know.
I think that, exactly. I think the question that the email that you forwarded to us should be, how can I improve on my yield for fixed income? And yeah, you may have to think about dividends off of some solid companies, okay? That may be one thing. Or take a look at some closed ETFs, closed bond funds that are run and will give you a steady 4.5 to 5.5%, okay? And if you want to know whether the risk is worth the reward, take a look at that and take a look at what your cash position is, okay? Most of the times we advocate a cash position of 5 to 10%. We've moved many of our clients up to 12 to 15% now, okay? Just in response to what Len's question was, somewhat the unknown, okay?
There was an article I read recently, and I was looking for it just before we went live here, and I couldn't find it, where the article described a lot of companies are eliminating the dividends. So how do you tell if a company can continue to pay the dividend? And they were talking about things like the debt service ratio. And
a quick look would be their earnings per share, okay? If they can support the dividend. You'd be smart to stay toward utilities, telecoms when you come to that. But you're right, many companies, or not many, some companies have reduced their dividend, cut it in half, so on, to hold on to cash through this situation, okay? Mm-hmm. So I think you want to be very selective. If you work with a financial advisor, I think it's a good time to set up, even if it's a remote meeting with them, as to how to allocate the money that you put aside, or maybe you've sold, and maybe you have a bigger cash position, okay? I think that may be certainly a valid exercise for you to do right now.
Okay.
I think if you look at what your expenses are, and if you put aside, let's say, 12 to 18 months worth of expenses in a money market account, you know, then if the market fluctuates, don't pay too much attention to it, because you've got enough cash to meet your needs. You know, the problem with having 100% in stocks is that if you need money, you need to sell stocks. And if it's a bad period and the market's down, you're selling at a low end of the market. So, you know, what Mike's saying is very important. Look at your cash position, see how that relates to what your expenses are for the next 12 to 18 months. And if you have enough cash there, you just sit it out, because there's no place that you can get a good return without risk. If you want no risk, you can buy a 1-year treasury and you get 20 basis points. So if you have $1 million in it, you're talking about $2,000. It's really nothing. So, it's hard to really buy bonds. You know, unless, you know, you've got so much cash, you got to put it somewhere. You put it in the money market and you accept the 0.2% or 1/10 of 1%.
How many people, by raise of hands, how many people are spending less this year than they did last year? Raise your hand if that's the case. Okay. So there you go. That affects almost everybody in this community, because you're not putting any children or grandchildren through college or something like that. And then they may not going. I have some clients that are taking a gap year and they're not going to school because they don't want to spend $60,000 or $70,000. And the child doesn't want to do it to do remote in college. So by raise of hands, it looks like about 90% of you have more cash in your bank account, savings accounts, wherever, money market, than you did last year. So
I think I'm spending more on food, but
yeah,
I'm spending less on restaurants.
right. But when you toss it up, I think you're finding, aren't you accumulating more than you did last year?
Yeah.
Anybody who's not?
Yes, I'm not.
Because?
I have a wedding coming up.
Oh, there you go. Okay. So let's hope it's a one-time event, okay?
Thank you.
Okay. So, yeah, that's a good reason, okay? So it may turn out to be less expensive because you'll have to see how many people show up, right?
Well, it's next year, so I'm sure they'll show up.
Okay. So you got time to go. All right.
Yeah.
All right. So outside of the wedding planner here, is there anybody else that spending more now in this environment?
Basically, I'm spending less because we can't go out and we can't go on vacations.
Correct.
So we're not spending that
So
money.
what are you doing with the money?
It's sitting in my mutual funds.
Oh, so you're investing the money back in. You're reinvesting?
No, not really, but I didn't have to take any money out. Let's put it that way.
I think you said last month to hold on to 10% cash. That's what you recommended, I think.
Yeah, I would even say you may, if the next 4 or 5, 6 months was you know, agita and anxiety, deal with it, because this virus is enough to make anybody depressed over everything else. So don't let the markets depress you. And there may be some things. I mean, I don't think there's anybody sitting here today that can remember a presidential election like this coming up, okay? Certainly with one candidate who seems to want to make the election invalid before we even get started, okay? So I think that you should take as conservative a point of view.
Forget it. I don't want it.
I'm sorry?
Does anyone have any questions that you would like to address to Mike or Morley?
I will.
Rick Simon.
Mark,
I just
go ahead.
read
I know him.
New Jersey is going to be borrowing close to $10 billion.
Right. So
Is that going to make
the one issue that,
bonds more attractive?
yeah, well, sooner or later, but not right away.
I don't.
The one issue that we addressed, I think, two meetings ago, and the one that's really running the show here is not all the noise that you hear on your television set, is the Federal Reserve. The Federal Reserve is pretty much guaranteeing that any municipality, that includes states, cities, towns, whatever, New Jersey Turnpike, they'll be the buyer of last resort, okay? So what that does is that makes every institutional buyer, banks, insurance companies, et cetera, mutual funds, that the other gentleman said, they're going to go into the bond market and they're going to buy, okay?
Including revenue bonds?
I'm sorry?
Including revenue bonds?
Including revenue bonds, correct. And you know why?
Wow.
Because what's going to happen here is that, let's say, use the Turnpike, whatever you want to use, the Port Authority, they're going to float $100 million bond, okay? So so maybe some people here might buy 10,000, 20,000. The institutional guys will pick up 5 or 10 million based on the Fed's signal, yeah?
So what happens?
If they only sold 90 out of the 100 million, that means the Fed will step in. They'll take over the last $10 million and leave it in the portfolio for the time being. Okay, it's a little simplification.
But they don't guarantee the 90 million, do they?
But that, it doesn't, you don't have to guarantee the 90 million. All you have to do is say that the bonds are liquid and that the states and the cities can get money to be able to float additional paper.
So what happens to the ratings?
The ratings, they may drop a notch, but I don't think so. I think they're going to probably stay where they are because this is such an unusual body event, okay? And if you start to see that revenues start to come back, then that'll support what's needed the bonds. For the most part, most of these municipalities or agencies have enough buffer that they'll be able to pay their bondholders one way or another. And what they do is float additional bonds to pay the earlier bonds, yeah? You're also dealing with an environment where interest rates are, for the most part, 0 to 0.25 from the Fed. So that means, let's take a state like New Jersey, where you may have seen a 5% or a 4 3/4 coupon. They may go down to 4 1/4 and 4 1/2. That's what the federal government is doing in printing money. Okay, they're borrowing, but it's so cheap right now, they're feeling a little more comfortable to do that. Therefore, my previous statement about watch 21 and 22 with some inflation. You're going to see it already in the supermarket. This is demand and supply. Everybody wants handy wipes and paper towels, and prices going up, okay? Get used to it, all right? Put a little money aside, because whatever it costs you in the supermarket, 4 months ago, you could probably add a couple of points sooner or later. Because like I say, watch the CPI and the PPI that comes out once a month. I think it's the second or third week of the month. And that'll give you an indication whether that's happening. Now, that's only in certain areas. You're going to get, anybody who want to go on a plane, you're going to get great airfares yet. Anybody who wants to try to kill themselves and go on a cruise, even better, okay? Hotels are going to be inexpensive for a while. You're going to have to wait to see how the demand and supply meets each other. Just like, if you remember, I think we had a meeting 3 or 4 months ago, and everybody was talking about the collapse in fossil fuels. Now you have demand and supply starting to meet each other at around $40 a barrel, right? So again, know who you are when you're going through this next 6 to 18 months. If you can't take the heat, then get out of the kitchen.
Yeah, I think State Farm Insurance sent me a letter telling me they're going to lower my auto rate by about 11% on my next premium. And I think that's across many, I think other auto insurance companies are doing the same.
All insurance companies have either given you a refund or discount your next payment, whatever. But again, that's like running around looking for CDs. No one's going to become a zillionaire on this stuff, okay? More important to look at the portfolio that you have, and you may not want to live with it going forward. Take a really good look with whoever you're working with and reevaluate what you need, okay? And if you have a little extra cash on the books, don't let it burn a hole in your pocket, right?
Let me just add, I don't think you have to worry too much about municipal bonds as far as safety, but you do have to worry about the price volatility of the bonds if rates go up. They work the same way as taxable bonds. If rates go up, the value of those bonds go down. So they have
to see if you were getting low.
And the same goes with your closed-end bond funds or anything. In other words, if interest rates, if you see the 10 years starting to move to 1%, yeah, it's 0.71, close of business today, that value that you have in that bond fund, or like Morley says, those bonds. So if you bought a $10,000 bond in the next year, it only may be worth $9,800. The good news is that if it matures in 2025 or 2028, you're going to get your $10,000 back on par. Okay, you may or may not spend par on it, but you're going to get yourself back on par. So that can be another meeting on, we want to talk about how to buy bonds and so on and so forth. How many people, by raise of hands, how many people own individual bonds? Uni bonds. Okay, good. And how do you go ahead buying it? Anybody want to participate? How do you buy your bonds? Somebody buys them for you?
Yeah.
I use Fidelity. My financial consultant buys them for me.
Okay, great. So be careful on how much you're paying over par for the bond, and see whether you want, how long out maturity you want to go. It's not the end of the world, but you have to balance that off between maturity, coupon, and yield to maturity. So if somebody's buying it for you, ask that question. Two things. One, is it callable? And you want to know the yield to call, YTC. And the second thing is yield to maturity. And if you ask those two questions and match up a couple of bonds, you'll feel much more comfortable that you know what you're doing.
I always
Excuse me.
the rating.
I'm sorry?
The investment grade.
Yeah, they have to be investment grade. I would usually you would say BBB plus. I'm most comfortable with at least A minus. Okay.
Why would you recommend bonds at the current interest rates?
No, I wouldn't.
Okay.
But you said that people had them bonds. Molly said before, I wouldn't be in the bond market now. Okay.
Right.
But people that have a bond portfolio, they're in. They're not liquidating here. Okay.
Yeah.
Bonds that we bought from 5 years ago.
Yeah,
No, I wouldn't buy a
fine.
bond now.
I mean, if you have big positions, let's say you buy $50,000 or $100,000 worth of a bond, you may want to take a look, and you may want to take a look and take a profit, okay? Because your interest rates are so low, the price
Right.
of the bond that you're going to get is probably as good as you're going to get.
So you think it's
So,
better
Michael-
to be in equities than in fixed income at this market?
I'm sorry?
You think it's better to be in equities rather than fixed income, given what's going on in the market or what could go on?
Yeah, it's hard to know. It depends on how much income you need from your portfolio, okay? It's kind of like a personal question there. I think if you're in equities, take a hard look at what the equities are, okay? And are you using that portfolio for income to support your lifestyle? I don't know the answers to those questions, only you do, okay?
What, the income from selling in your portfolio, or the income from the dividends in the
No,
portfolio?
the income from the dividends and what the bond is throwing off. I'm saying that you may want to take a look at that if you have a big bond portfolio, and for the gentleman who has a wedding coming up, he may want to sell part of that and take some profit, because the value of that bond may go down over the next couple of years if interest rates go up.
Right.
If he waits till 2020, whatever, 7, 6, whatever, he'll get par on the bond. Okay.
Yes.
So,
Michael, a quick question for you, if you don't mind. So let's assume there's fresh money coming into portfolio as a result of an asset sale.
okay.
You have 2 years of expenses available to you in cash.
Right.
And what would be the allocation that you would make on that new cash coming in?
How much is the new cash in percentage to the total portfolio?
Well, in terms of liquid assets, it would probably be in excess of 70%.
No, in terms of the total portfolio.
Well, if you include real estate and such, which tend to be illiquid.
Well, let's just look at the liquid part of the portfolio.
Right,
Stocks,
that's why I say that.
bonds,
Right.
Stocks, this is 70% of the liquid part of the portfolio is coming in?
Correct.
Money?
Yes.
I would lean to in the stock area if you went 50 or 60%, but carefully selected here. Okay, are you working by yourself or are you working with somebody? Are you doing it for yourself?
I don't do it myself, no. At the moment, I have a couple of advisors,
Oh,
but
good. You're
I
paying
join.
You said you're paying them. Okay.
But I've always made decisions by consensus, so I always like to get multiple views and kind of assimilate them and then see which way I'd like to go. So I'd be curious to.
How old are you?
66.
Oh, okay, so yeah,
I have longevity in my family. My grandparents lived into their late 90s.
great. I would be comfortable with selected equity positions, conservative. I would be comfortable with 60 equity, 40 fixed at this point.
And the equity, would those be funds or individual stocks?
What do you have now? I mean, what are you used to?
I'm used to funds.
I would stay there. I mean, if you wanted individuals, I'm sure the fellows that would be working with you, I would stay along the line on individuals of what I said before, whether it be utilities, telecom, so on and so forth. I'd put a small part of that over into technology, but you could buy that through Vanguard or Fidelity, so you don't feel like you have to pick one horse.
Excuse me?
Where,
How he allocates the 70,000 or the 70%, shouldn't that also be based on where he's invested the other 30%?
sure, that's
Put
why
the
I
whole
asked.
thing together and you get
Yeah,
a more
the rest of the
appropriate
point, that's why I
allocation.
say you really have to take a look at this, you know. I mean, you're in a very, the fellow that gave the last talk, okay? You have two ways of looking at what's going on in the world today. One is looking backwards and one is looking forward, okay? I think we're at a very exciting time, even in spite of the political atmosphere in the United States. Put that aside for a minute because we can both take, or can all take sides on this. But it strikes me like the beginning of the 20th century with automobiles. I think we talked about this once, you know, airplanes, all of the things that happened between 1890 and say 1920, 1925. We're in that same type of space right now. Extremely exciting. And what this virus has done, it's fast forward what was going on before, okay? Now, a lot of it can be toward technology. And instead of picking one technology, I like this better than Slack, or that Google's gonna buy this, I would say that for probably most of you that don't get into the technology game, maybe Steve Birnbaum could be a better picker along those lines. But I would say, you know, pick up a Vanguard or Fidelity technology fund, or even some next generation funds, so that you're in the game. That is going to be the game once we get through this craziness, and we will. It's just a question of when we will get through the game, all right? So that's number one. Number two, so there's really a lot of excitement that's going to go on, and people are going to fall by the wayside. Companies are going to fall away. There's going to be quite a bit of upset because people aren't working. Many people aren't as fortunate as all of you on the screen, okay? And they're trying to make ends meet at the same area. And we may have some civil unrest. So most of you remember 68, 69, what was going on. You had the Vietnam War overlayered to change in the 1960s when we were, you know, teenagers or 20-somethings, okay? But what comes out of that is usually a whole new situation that takes us forward to the next step, okay? And look at the geniuses that you're looking at right now. Unbelievable. Amazon, Google, Tesla. I mean, it's incredible. You hear about them every day. You take them for granted, but you're going to look back, or the children or grandchildren are going to look back and say, gee, that must have been a great time when all of these people developed these things, right? So try to grasp some of that in your 70%, especially since you say you have 18 months of cash on the sidelines. That should do it, okay?
One other thing, you should also look at how the pandemic will ruin certain investments and what you can get out of.
That's right.
If you're invested in commercial real estate through an REIT or something,
right.
Maybe that's not so good. Because
right. You're getting whacked. You're getting racked right now. So all of you take a look at that. That's a good point. Thanks, Richard. Take a look at that and see whether you're going to risk that. Now, somebody said they had investments in real estate. You got to take a long view on commercial real estate, and you may lose your monthly payments from those REITs, okay? Probably most of you in real estate that are in your portfolios are REITs, right? Real estate investment trusts. You may be getting 6, 7, 8, 9%. You may in the next few quarters get cut in half. You may cut to zero. they may have to hold on to that capital that they want to do. So take a look at that. So like I say, I urge you to stop running around and looking for 0.6% on a CD, so on and so forth. Take the time to look into your portfolio. That's where the money is, okay? And if most of your money is in CDs, it doesn't matter. You'll start to lose some if we get this inflation, because in disposable income, you'll have less by 2022 and 2023 unless you accommodate that, all right? So focus where the meat is, not where the fat around the edges are.
Michael, I found out about, there's a site that rates dividend paying stocks called DivCon.
Okay.
And it's part of, you just have to search, it's rating by realtyshares.com. And I was just looking at it today to see. The only REIT that they had listed was something called Realty Income. That's a REIT that pays 4.5% monthly.
Yeah, the symbol on that is O, right, isn't it? O?
Yes, oh,
Right.
right, yeah.
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 Again, you're going to have to learn to rough this. Whoever said about commercial real estate, you're absolutely right. It will probably come back in a different form, okay? Things are going to change, just like the shopping malls. Big change coming up. It's already come. You know, embrace the change. When we get to our age, you're running away from the change. Embrace it, okay? Embrace it in your investments. While you have your income, most of you appear by what you say to us, Molly and myself, that you have enough money on the side. So look ahead over the next 3, 5, 10 years. Don't be afraid of the change, okay? I'm more concerned about the civil unrest than I am about the change.
Michael?
Yeah.
I was just kind of curious. I know you wanted to stay away from politics, but the philosophy of both parties are so different. Whose philosophy do you think is better for the economy? I know, I mean, without, getting into name calling.
Yeah, okay. Yeah, all right. This is my opinion. Wally may have a different opinion. My opinion is no matter who gets into office come January 20th, you're going to have to pay the piper. You can't start to run an economy that you just added 3, maybe 5 trillion by the time we get it, before things are going to start to come due, okay? And so what you have on one hand, where you have the Fed going, and then you have Congress, so you have both monetary and fiscal policy, right? You're going to start to have some inflation. What the Fed is going to start to do is gradually, 1/4 point, my guess is, and this may not happen for another couple of years, or it may happen next year, going to start to slow things down because prices are going to start to heat up. Going back to our supermarket example, right? If you were in the Clorox or handy wipe business, hey, and you used to charge 10 cents, you're charging probably 12 or 15 cents. Why? Because you can do it, all right? So no matter who's going to be in office, sooner or later, you're going to have to pay the piper, all right? I look at it as the Democrats, they'll hit the companies first, and then the high income people as far as income tax, all right? It's hard to know on the Republican side because some of this doesn't make any sense at all, but sooner or later, you won't be able to give tax cuts. I mean, what you have on the Republican side is you have a realtor that works on debt. So that's how he focuses on the country. I've always lived on debt. I've had 4 Chapter 11s in my life, and that's what we're living on right now. There's going to be a price to pay. You may be paying it as inflation. So your $1 million that you may have in the bank, or the 70% that you're bringing in, let's say it's 70, so 1,000 out of 100, may only be worth 65 and disposable in another year or so. That's going to happen one way or another if we don't address the situation, okay? And the situation will be addressed one way or another. The Fed will slow things down without a Republican administration doing it, right? The reason your companies are doing so well, if you're in the equity market, is they made 11% on the bottom line. They had a taxable rate of about 32%. I think it's 21.5%. So if you sold the same $2 billion worth of goods, you made more money by doing nothing, just selling the same $2 billion worth of goods, all right? So now you have to make this decision what you want to do. As I look at the election, it's even bigger than the finances. It's what I said about embracing technology. There is change coming in this country, okay? All of us, as I'm looking through the screen, all of us will have to get used to diversity. Just, again, either embrace it or fight it. You can do either whatever you want, but you feel that that's coming along, right? And as a result, the better we embrace it peacefully, we'll have a financial system to talk about. Again,
will they defer raising the taxes if the unemployment level continues to be this high?
Yeah, they may not even do it until late 21, okay? Yeah. The odd years are better because then in 22, all the members of the House run and then a third of the Senate, okay? I'll give you one other constructive idea based on all of this facts. Those of you, take a look at your percentage of your total assets, real estate if it's investment, don't count your house, and take a look and see how much of it is in qualified accounts, 401ks, IRAs, any type of IRAs. This may turn out to be in 2021 a good time to possibly flip some of that money over. And what's the assumption here? The assumption is that you're probably somewhere between the 22 and 24% tax bracket. Check with your accountant, okay? It may turn out to be the best time ever to take some additional money out. Plus, none of you have probably taken RMD if you don't need it. Anybody doesn't know what RMD is? Required minimum distribution? Yeah? You may want to take a look. If more of your assets are in qualified plans, you may want to take some of that money, especially all the money you're saving, not going on cruises and so on and so forth, and take that money and have it as after-tax money as you march through your 60s, 70s, and 80s and keep it there. It's up to you individually. I think it's worthwhile talking with your accountant or financial advisor.
You mean to move it to Roth IRA, I assume?
To move it to what?
To Roth IRA, to make a conversion.
You could do Roth IRA. The only thing you got to know about Roth IRA and from the CARES Act is that in the Roth IRA, you have to leave the money that you flip over for 5 years. So make sure you don't need it for the next 5 years, okay? So yes, and the Roth IRA would be the same thing. You have to pay the taxes on it. But then the Roth IRA will grow tax-free as you go along. So I think that's a worthwhile strategy to take a look at while everybody's bemoaning their fate about the election and this and that and everything else. There are things to be done this year. Don't let it slip through the cracks.
Let me just add something. I don't think that you should worry too much about the election and how it's going to affect your portfolio. I think you should, have a discipline that how you invest your money, and it doesn't matter which way the election goes, because there's experts who tell you one way, just as good experts tell you the other way. So the conclusion from that is nobody knows for sure what's going to happen. So, don't change your whole investment profile and the way you invest based on what you think the election is going to do.
And to point out Molly's point and back to Alan's question, isn't it interesting that the administration is negotiating with the Democrats on the Hill? You know why? The Republicans won't even talk to them, okay? Nothing can happen through the Senate. So what the administration is trying to do is get the Democrats on board to pass something so that'll be more positive for the election. The Republicans don't care. They went home already, okay? So the Republicans don't have, even though they're the majority in the Senate, they're not going to be voting for, they don't want to vote for anything. So a few moderate Republicans plus the Democrats will push, what do we have to phase number 4 or 5, whatever it is, will push something through probably, sounds like mid-September, because everybody's on vacation. What's the story now? I was on vacation until after Labor Day, okay? So Morley's absolutely right. Don't get overly wound up in the headlines. Focus on where you're at. And good luck on your wedding, you know?
I have a question for you. Part of I believe, the Democratic platform is they want to eliminate long-term capital gains and make and turn it basically into ordinary income. So the question is, if it looks like the Democrats are going to win going into election, number one, that's probably going to put some negative pressure on the market. And the second question is now a time that we should start maybe selling at relatively low income tax rates in case that does happen?
I think yeah, I mean, if given that thesis, okay, I'm not sure that'll happen, but that's a possibility. And I think if we talked about raising cash, that's one way to do it, okay? The retail investor has a hard time, not buying, has a hard time selling, okay? I've said this before, and it's still valid. You've got to know what your goals are, even for your individual or your mutual funds. If something is too good to be true, you know what? It probably is, all right? So take, again, like Molly and I said at the beginning, take a look at those portfolios. Take this time, instead of woe is me, take a look at the portfolios. You may be 100% right. We're going to have to raise the money somewhere, okay? Sooner or later, like I say, we're going to have to pay the piper. Otherwise, you're going to have worse than regular inflation, okay? And we all experienced that in the 70s for other reasons. So take a look at that. You can accommodate, if the economy grows at a certain rate, you can accommodate more debt. That's true, okay? That being said, there's a very fine line between the two. And with the cash that we all say that we're savings outside of the man making the wedding, use that cash then to buy opportunistically. Again, the challenge for the retail investor is that they hide under the covers. When you come to late February, March, April this year, the world is coming apart, okay? Try to think a little differently. And I think you'll find yourself successful by 22 and 23. Again, with good cash positions, yeah.
Michael, I have a question. You said the world has changed. That's certainly accelerated due to the virus. And it's in technology in particular. The company that's developed the most is Amazon, and possibly Tesla. But would you, given the high price to earning ratio of like Amazon's something like 149, 150, and would you still consider purchasing companies like that?
Morley can address what he's at. That's why I said take a Vanguard and Fidelity technology fund, okay? You're not going to put enough in Google, Amazon at their prices, Tesla, that's going to make a difference one way or another. So why not buy and let the experts that live and breathe this every day, let them run your money? Because what do you put in? $10, $15, $20,000? So have it diversified, okay? And so, you know, you're not going to make $1 million one way or another. You're not buying big enough positions to make the difference. Yeah?
That's true.
I would say, Len, if you haven't owned those stocks, that if you feel that you have to own them, then go in and buy a little bit at a time. You know,
right. It's okay too. Yeah.
You know, if you
have to have one company.
Yeah,
you're a little late to the party. Yeah, but
yeah. Yeah, my girlfriend Judy bought 2 shares back in March, and she's having fun.
Oh, good. So,
yeah.
I mean, great. Fine, you know, that's okay.
They can't go up forever and ever and ever because it gets harder and harder, you know, to grow your company if you're, you know, I don't know, if you got hundreds of billions of dollars in sales. But, you know, the only thing I would worry about Amazon is that the government can come down on them because of unfair practices. You know, I know somebody who knows somebody who had this diapers.com, and he was doing very well. And Amazon came to him and said, I want to buy your firm. And he said, I don't want to sell it. He said, well, if you don't sell it to us, we're going to put you out of business because we're going to sell diapers cheaper than you sell them. And he ended up selling them, selling the company to Amazon. So, you know, with those kind of things that they do, you could see some government action against them. So that's the one big risk in it. And the other risk is that, maybe priced too high right now.
Mhm.
But let me say one other thing, that we have, clients, let's say in their 80s, and they say, I really should have a more conservative portfolio. And I say to them, and these are people that have enough money, I say, you're not going to spend all this money. What are you going to do with your portfolio when you pass on? I'm going to give it to my kids. Well, then maybe your portfolio should look more like what your children would put it together, not what you put together. Okay, so you can get too conservative when really you don't have to. So I just point that out because we see that a lot where as people get older, they want to cut back on the equities and they want safer equities, but that's all going to go to their children when they pass on anyway. So take that for what it's worth.
I agree with Molly 100%. That's why I say to you, take a look at technology, take a look at Vanguard has another good also health technology closed-end fund. We didn't even talk about, big pharma and medical devices. That's growing by leaps and bounds, and again, being pushed by the virus, okay? And, somebody could make a case here that, hey, this is maybe a start of a flu or a virus kind of situation every 5 years as this world becomes smaller and smaller. So you may want to step in and say, hey, you know what? I'm going to take a position in some of these healthcare. And that goes right down to, say, like a CVS. They're definitely on the cutting edge. And remind me, did we not talk about this already on CBS? I think we did. They figured it out. They have an insurance company. They have doctors and nurses in their larger units already. And they're in the pharmaceutical business. So talk about vertical. There's a lot of exciting and interesting things going on. Just look around.
Okay. Anyone have another question? Okay, well, we've been on about 47 minutes, so this is going to be this is being recorded. I didn't start at 0. I started about 1 minute in, so, but
yeah, Len, did the fellow that wanted, I didn't want to poo-poo it, did he get the answer about his CDs or so on and so forth?
Mark Ben.
Yeah, it's not a CD question. Can you hear me?
Yeah, I can hear you. Go ahead.
Yeah, it's not a CD question. It's if you have 10 to 12 months of cash that you should hold as cash, where should this cash be?
In the money market.
Yeah, I mean, in money market's giving 1/10 to 0.2%, depending on who the money market is, and it's going to continue to go down. So for the most part, if you're holding, so let's say it costs you $10,000 a month to live, okay? Right. You don't have to have $120,000 in cash, okay? You can have enough fixed income vehicles that'll throw off income monthly, okay, for you to cover part of that $10,000 a month nut.
So right? Should I invest then the money and not worry about that and just leave that? I know I can get liquid cash.
Yeah, I would say that probably given 6 months is probably, unless you're giving me a scenario that whatever you're living on now as far as income could become crashing down, I mean, that's, can a meteorite hit the earth? Sure. I mean, how much is enough? So normally, if you have 6 months of cash on hand, you can put the other money conservatively to work.
Okay.
Steve, you have any questions?
I have one other question.
Go ahead.
Okay. If you have a bond, which I happened to look at the other day, it's an old bond, but the value of the bond is 1.5, 150%, because the bond is paying over 6%.
Right.
It's an old Merrill Lynch bond. It's a $10,000 bond. So I could sell it and get approximately $15,000. And it would have, I think it has another 8 years to go. Okay. Am I better off to keep it because the rate is so high, or do?
Well, what do you use the money? What do you use the money for? I mean, if the $10,000 bond is part of $1 million portfolio, you've answered your question, okay? It doesn't make that much difference one way or another. If you're the gentleman that has the wedding and he's looking for an extra 10 grand or 15 grand, then cash it in. You're paying, you're gonna pay taxes on that.
That capital, but you can offset it with the loss.
But so what? Okay, that's what happens when you make money.
Okay.
And you could make a case like the other gentleman who asked, you may be paying more when you're selling in 2 or 3 years if the tax rate is going up. Yeah.
Thank you.
And yeah, Steve, did you want to kick in about technology or anything? Yeah. Do you feel we missed anything?
No, you hit everything. You know, but you know, you look at an Apple. Matter of fact, I was in the mall. I was in Freehold Mall today. You know, Microsoft closed all their retail stores, so they're out.
It was probably a good move on their part. Yeah.
So when you walk, you know, I remember a few years ago, it was during the holidays. It was during a week during the holidays. I'm walking in the mall, and the stores are empty. This is like 2 or 3 years ago, or 4 years ago. The stores are empty. I mean, nobody's shopping during the week, right? I get to the Apple store, and there's a line, a queue, you know, with about 100 people on the line.
Just trying to get into the store, right?
So what you do is you go home and you buy Apple. That's what you do. So I was there today. There had to be 50 people online for Apple.
Amazing.
Today. You know, the rest of the stores, dead, either closed or gone, or, you know, nobody on.
I'll give you just a quick example of this. I have 2 clients that inherited Apple, and I think the cost in the stock was, I may be off a few pennies, $9.80, okay? Needless to say, I think they inherited, and the money and the stock was bought in the late 90s, okay? And we had a heated discussion a few months ago because I started to say that because the way that Apple has continued, it was disproportionate size for the total portfolio. And I urge you all to take a look at that. Do you have disproportionate? Anybody that owns Microsoft, take a good look at that. It's like Morley said, nothing goes up forever, okay? And there's nothing wrong with taking a piece of it. It's not black and white. It's shades of gray. There's nothing wrong with taking off 5 or 10 or 15%. Again, this is a good year to do this. If you haven't taken R&D, you're making less money this year than ever before, okay? Because your reportable income is going to be lower because you don't have to report that. So take advantage of that while everybody's sitting home waiting to get better or feel good or opening up, whatever. So take a hard look, and there may be opportunities for you to raise that cash, to redeploy it, whatever the case may be, right sitting in front of you. So if you own 200 shares of Apple, so make it 175 after this year. And yes, you will have to pay long-term capital gains.
I have a question, and I agree with what you're saying, but if you did that 5 years ago, because your Apple position got pretty large, look how much you've lost, opportunity lost in the last 5 years by winding down 5 years ago.
Yeah, but you know what? So what? Instead of the 200 shares, you had 175, okay? And that isn't a pure opportunity loss, because if you took those 25 shares and you redeployed them, you probably made money in the last 5 years also, okay? But the risk that a company, Apple or any other company, may have been at too high a point and becomes a disproportionate part of your portfolio, okay? And like I say to you, that's the challenge for the retail investor. They can't pull the trigger to sell something and then, or ask a question like you just asked, so what, okay? So that's the old equation of time and money. It's not like you took the 25,000 and you went on a trip. I'm assuming you redeployed it to something that may have worked out fine, okay? And you still have the 175 shares left. But if the company for any reason trips up or makes a mistake or whatever, what's the downside on that, okay? So, like I say, take a look at your Microsoft positions, take a look at all of these crazy positions that may be, because what is driving this market right now? We said it at the beginning. And sooner or later, you know, like I say, you'll come about and say, whoa, I really wish in August, I really wish I took a look and paired my positions.
What's
Then
the
you-
percentage that you think it gets too high?
Well, portfolio managers will tell you anything on an individual stock that's
Yes.
more than 5% of the portfolio is out
More
of
than
whack.
5?
Yeah.
Okay.
Well, if that's true, that means most people have over 20 individual companies.
I don't know that. Why do you say that?
5%. If
Well,
anything over.
I mean, they may, or maybe they have more than that. I don't know. But you're asking me what it is. Take a look again. So if you have $1 million portfolio and your stock, the stock, make it Microsoft, whatever, is worth $100,000, that's 10% of the portfolio.
You think that's too high?
Well, I don't like one company, as in my business. I don't like one client running my business either. Okay.
Uh-huh.
I don't like one company running the portfolio. That if the company stumbles, yeah, Cisco today dropped 8%. Intel a couple of weeks ago.
Yeah.
Those were like pure gold of the technology era. Okay. But for different reasons, they're not doing as well as many of some of the other things I could show you in technology.
Right.
So again, I go back to the retail investors have trouble selling on their own. Okay. It's not I'm not throwing darts at anybody. I'm just saying it's an observation.
Mike, the big mistake that most investors who do it themselves make is they don't know how to assess risk in their portfolio.
Correct.
So and I'll give you an example. Let's assume you own one stock and that's your whole portfolio. You think that's risky?
Yes.
Okay, two stocks reduces your risk a little bit, but it's still risky. If you look at most mutual funds, they have maybe anywhere from 50 to 300 stocks in the portfolio. So diversification is very important. It's not it gets riskier and riskier as you let one stock make up a big part of your whole portfolio. Take a stock like Polaroid. I don't know if you ever bought Polaroid. It's a stock that did super well. And it was a great company. And Kodak, another great company.
Yeah.
They die out.
You and Trump on Kodak. Yeah. You saw what happened to Kodak, right? Okay.
Yeah.
Well, the new Kodak, KODK. Yeah. And what, just piggybacking on what Morley and Steve says, take a look from when you started investing, you've been in there, technology was always on the outer fringe. Okay. Technology is going to be the core of the 21st century. Okay. I don't care if it's robotics. I don't care if it's AI, artificial intelligence. Make sure you're allocated that way and have that full conversation for all these people that are buying things for you. Have that conversation and challenge them. Make sure that your portfolio is looking forward to 2030, not backwards to 1998, okay? This is not a late 90s situation. It's completely different. And the virus has fast forwarded us possibly by 2 to 3 years, right? So, and I can tell you that from personal experience because I'm working 75 to 80% of my time remotely, okay? And I never thought I'd be doing that. So welcome to technology.
Yeah, Mike, the other thing I noticed, Verizon, you park money in Verizon, good yield, So I noticed today, I was looking at some of the ratings, some of the investment houses, that give you the hold, buy, sell,
Sure.
So I think it might have been Merrill Lynch and it might have been, I don't know, Morningstar was another one. And there was a third one. One has it as a hold, one has it as a buy, and one has it as a sell. So there's where your individual investing, where do you go?
That's what makes a horse race, right?
That's why you use an investment guy.
I think it's helpful if you're doing it on your own. I think you take a look at why you own it. Are you owning it for 5G? Are you owning it? It's got an excellent balance sheet and a very decent dividend. If you're willing to take some of that money from telecommunications and say, and again, I think we've had this conversation through the first part of this year, and say, maybe, do I want to be a little more risky and take a look at telephone. I think we talked about that, AT&T. You're getting even a better yield, but not as good a balance sheet. okay? But most of the analysts there have it as an update of somewhere between 15 to 18% on target prices, okay? And again, if you want to, you can certainly call Molly or myself if you got a question about a particular individual stock like that, and I'll give you the best, knowledge that I know. But again, if you're not comfortable with that, or you're not working with somebody, then do a closed end or a mutual fund, because then you've cut down your risk. Like Molly says, risk. You've cut down your risk. And believe me, the funds are going to go down. When the world came apart in March and April, your funds took a dive because they're made up of all these stocks we're talking about. So assuming that you're keeping the 6-12 months in fixed income and so on and so forth. Now, and money market. Now, interesting to note, until the Fed moved in a number of different ways, fixed income got whacked also, okay? It fell down, especially preferreds and things like that, until the Fed says, whoa, don't worry about it. We're buying those, all right? So if you take a look and see what March, April, go back and see where your portfolio fell on its face in those 60 days. Then you want to be maybe a little more careful, okay? And you'll, as Molly said, a little more about the volatility and risk, okay? And I think it's a great idea to play defense, okay? Because nobody knows. Nobody knows about the election. Nobody knows about this virus. Everybody gets on CNBC and gives you an opinion. They get paid to do that. Wonderful. Right?
So, Michael, a big picture question. Earlier, I had mentioned there was a capital gain due to an asset sale sometime this year, and I have losses on cannabis stocks. They're all underwater.
Right.
I've owned them for over 18 months. They had a run up, and I didn't sell them when they were at the peak, and I held them too long, and now they're all underwater. So would you recommend selling them and take and offset the gain from the asset sale, or continue to hold?
I don't think that's a bad idea. I'm the wrong person to ask. You should really be asking your accountant, as far as a tax type of situation. But I don't think that's a bad idea. I think we all got too excited about, that everybody was either going to be eating or smoking grass for the next 25 years in those stocks. And unfortunately, they rolled out nationally, Canada, and what is it? I think 10 jurisdictions or 12 jurisdictions in the United States has allowed it to happen. So I think you may ask yourself, if you're running your own portfolio, why you didn't have trailing stops. Tell me if you don't know what that is. Trailing stops behind the stocks as they went up, and then you wouldn't have been caught in that position. Okay. So
because I'm not a professional, that's why.
Well, okay. Well, then that's your choice. Okay. To how to deal with that. But if the stock goes from 5 to 8 to 10 to 12, you should be putting stops. And if it pulls back, then all of a sudden it'll sell. You'll have it sold, and you would have made money, not lost money.
Correct.
Then if you get into a situation, like March, should be 100% cash.
Gary.
What's your recommended backstop, Michael, on a trailing stop?
When?
I'm sorry, everybody.
What's your recommended backstop on a trailing stock? 10%, 8%?
Yeah, no, nothing less than 10%. Otherwise, you won't have the wiggle room. It'll just,
right.
It'll just go up. And in some cases, I've allowed Microsoft to go up to 215, 218, and I had a 200 stop on it. Okay, so whatever that turns out to be.
That's only 9%.
I'm sorry?
That's only 9%.
Okay, so I'm okay with that. I mean, I'm okay with around 10%. Okay, and again, know what you bought it at too. So hopefully we're all making money. Okay, but I'm assuming that you made money on the cannabis stocks and they went up. You're going to have less wiggle room when it's a lower price stock, because it's not unusual for these to flip around a little bit versus Microsoft at 200. Okay.
But you have to be careful with the volatility today. You could, a stock can go down 10% overnight.
Well, I'm assuming that you're doing the trail, so you made money. Okay?
So you keep moving it?
That's what I do. Yeah.
Okay.
So again, making money is not a bad thing. That's what you're in this for, okay?
Right.
And when people start to tell me, oh, I have to pay taxes, oh, woe is me, then, go to money market and CDs. You won't have to pay any taxes at all. Right?
And Mike, let me interject something. The fellow that has the big gain, I think you should take your losses on the stock to offset the gain. If you want to keep the stock, you can buy it 32 days later, buy it back, or you can buy the stock today and 32 days from now sell the stocks that you have a loss in. So you still have your position and you use the loss to offset the gain.
That's a good point, Maury. Excellent
point. Yeah,
right.
no, very good. You're right. That,
Yep.
that makes a lot of sense. Thank you.
Okay.
Michael,
Yeah.
let's assume you take a look at technology and you like the stocks in technology. Are you better off buying it as a sector or going into large cap stocks? How would you play it? In other words, the same stocks are in the tech and the same stocks would be in a large cap fund. How would you play it?
Well, the large cap growth is going to have other stocks that's going to dilute the concentration of the technology. So if we're going with technology, take a stand. Go with technology.
Okay.
That doesn't mean you can't buy large cap
No,
stocks.
I understand.
Your question was toward technology. Yeah.
Right.
What is your view on cannabis stocks now, just for the next 2 years?
Molly, I don't have an opinion on them.
I have an opinion.
I don't see much growth at this point. You're going to have a change in legislation in the United States.
Right.
We've got more problems than we know what to deal with. I don't see that getting through right now. So I think you have in the limited jurisdictions in the US, and I think we all got carried away with Canada. What is Canada? 10, 12, 14% of the population of the United States. So,
right.
I think there's there are many citizens in this country that are worried about the protests and so on and so forth. There have been some studies done in Colorado, California, a number of other places that have legalized it, and there have been incidences of crime, motor accidents, so on and so forth. So I think it may turn out to be more of a social issue than anything else than a financial issue. I'm not sure that we're there for legislation to go through at this point.
A lot of the growers are not making any money.
Yeah.
Yeah.
Growing it, with all the regulations that they have to do for the state and whatever it is, local regulations. I don't think it's a good investment, but maybe I'm wrong. Or if you want to put 2% of your portfolio into something like that, that's okay.
Got a very low barrier to entry. It's very easy to open up a greenhouse and put the fans there.
Very good point. If you want to, it's funny, if you want to talk about barriers to entry, I just had this conversation with somebody the other day. I don't know how the bunch of you feel about Boeing, okay? So that's something I'm not the proudest of, but we own it somewhat in our portfolios. But talk about barrier to entry, nobody's stepping into the airline business, okay? And Boeing, depending on which day, and again, you have to have stomach for this, is selling anywhere between 40 and 60%. If you take a look at the average that it sold back in 18 and 19, there's a barrier to entry, okay? So if you're looking for opportunities, once we get through this, and once the airlines start flying again, rather than buy the airlines, I think I would look toward Boeing. But again, you have to have the stomach for this, all right? There's a certain, as Morley said before, there's a certain amount of risk, and you have to be willing. And there you may, if you buy it at 170, 160, 170, you may want to put a stop in it at 120, okay, whatever, and say, hey, I've had enough pain. But I think the upside there may turn out to be in 2 years. It may turn out to be pretty good because of barrier of entry. Nobody's getting into the airline, manufacturing of aircraft.
That's not good. They also cut the dividend to zero.
Yep, exactly. You all, which is good for the company and good for the stockholders. You didn't buy it for the dividend to start off with, right? So there are the kind of things. And again, are we looking at space travel? You've got to know that Boeing is going to be involved in some of that. take a look at the future. And, you know, I said that before, take a look at the future and see what some of those opportunities are.
Okay. Okay.
I had an uncle that always said, buy a fallen giant.
Well,
Buy a fallen giant.
sometimes yes, sometimes no.
That's like Boeing.
Yeah, well, Morley brings up Eastman Kodak. I mean, Xerox.
Sears.
Yeah, Sears, JCPenney. Yeah, so, and that's a very good point, okay? You know, what are the malls gonna look like in 2025 and 2030, okay? So.
Old age homes.
Amazon.
Fulfillment centers.
Fulfillment centers, maybe. I think there'll probably be somewhat more kind of convenient office space, and it may turn out to be small businesses that don't have to be retail. It could be mixed usage, okay? So, you know, watch how that goes, but you gotta see how this works out. That's why there are so few Bezos, and, you know, you have to have the vision to be able to see where it is and put your money where your mouth is. You know, if you think that's so, you know, it's not easy to do, believe me.
I agree.
Thought I was doing that with cannabis.
Yeah, so you turn out to be partially wrong. So either do what Morley suggests or take your licking and go in. Don't be shy on the next run. That's okay.
I don't know whether it's on the ballot in November, whether we're going to legalize cannabis or not. I can't remember. Steve, you remember that?
Oh, in New Jersey?
Yeah.
I don't know if it's getting onto this ballot. I'm not sure.
Yeah.
I know they were talking about it.
I know the legislature doesn't seem to want to touch it with a 10-foot pole. So,
Right.
Yeah. Okay, if there are no other questions, I appreciate everyone showing up and asking stimulating questions, and I appreciate Mike and Morley answering the questions and giving us some good information and advice.
Thank you for putting it together.
Yeah, thank you very much. Very informative.
Thanks, Glenn.
Thank you very much.
Thank you, Len.
Mike, I appreciate your coming on, and Morley. It's really important that we have some professionals, you know.
Agreed.
You're more than welcome.
Yeah.
Thank you.
All right.
Thanks. See you next month. Right.
Yeah.
Thank you very much.
I'm gonna I'll talk to Steve. Steve's been helping me with the video. I'm gonna post the video when it gets processed, and we'll let you know.